Inflation had a surprise uptick. Rates and bonds wobbled, and the stock markets, especially many of the biggest stocks, performed well yet again. The chance of recession is dropping, but still exists. But it wouldn't be surprising if more volatility were on the horizon. We'll cover that and more today in this quarter's quarterly context. I'm Greg Patterson, CEO of the Advisor Group. This is the quarterly context webinar for the first quarter of 2024 for friends and clients of the Advisor Group. For those that aren't familiar with the Advisory Group, we are a wealth and life strategy firm focused on helping business owners and leaders with their financial goals in their personal and family realm, their fiduciary and employee support efforts and retirement plans, and their communities through their foundations and endowments. We will focus primarily on the first section of this webinar, which usually takes about 15 to 20 minutes, and then we will circulate a video link should you like to view a portion of it again or to share it with someone that you think we can help like we've helped you. We'll cover a number of topics. As usual, we like to remind people to focus on the space between the things that matter and the things that can control. There are a lot of things that may matter, but not all of them are controllable. That includes markets, inflation, and so forth. And this is a helpful rule of thumb in many regards. As a reminder, our business model is all about the client, focused on client-oriented, client-focused advice without conflicts of interest, and it's an honor to serve our clients in that capacity. There are always news elements that affect markets to some degree. This last quarter had fewer bumpy moments, maybe related to news than some periods, with rates being a little bit wobbly, but markets still pushing forward somewhat surprisingly strongly in terms of stocks. We're coming out of a period of the greatest number of consecutive rate hikes from early 22 to early 24, up 5.5%. Now the markets are waiting for rates to come down. They've been hovering at that higher level. The Fed has resisted lowering rates, however, because inflation has been stubborn, has come down from around 9% to about 3%, but the Fed's target of 2% has been elusive, and the Fed does not want to lower rates and trigger another round of inflation and have to raise rates again anytime soon. So they will be patient and are, to some degree, risking the chance of recession. However, the overall economy has been surprisingly strong, and it doesn't appear that recession is on the immediate horizon. Stock markets, broadly in the US, up 10%, down -1 almost in terms of bonds because of the delay or the signaling that the Fed has sent that they are unlikely to lower rates. So some of the higher bond returns that investors expected will be pushed out a little farther into the future, and as a result, bond markets were a little bit bumpy. The unemployment rate ticked up a little bit in the last quarter, and gross domestic product, or GDP, cooled to a more normal level from a higher than expected 4.9% in the prior quarter, and the forecast of the Fed for 2024 overall is around 2%. As you can see, stock market's quite strong, generally speaking, up 10%. That's higher than the full expected return for a year. This was just for the quarter. International at about 5.6. Emerging markets on track to be ahead of the full year return with this kind of return, but it looks pale relative to the very strong international and US markets for the quarter. Real estate cooled a bit, as did the US bond market, while global bonds were positive. If we look at these different time periods across the different categories of US stocks, from large companies to small companies and from value to growth companies, you can see that over the last 10 years, growth stocks have really had a significant return advantage. That has continued to play out in the recent year. And from the bottom of the market in 2020, those large cap growth stocks have had a significant cumulative advantage as well. As some would say, as we'll talk about a little bit later, that there may be some overvaluation in some of the stocks, and some of those recently did have some cooling. Overall, we can see where we are with relative to the markets. If we take the 4 worst markets, this global financial crisis, COVID dip, rate period dip, but still on an inflation adjusted basis, the current market is doing considerably better than the other 3 of the worst 4 markets in history, if we include the global financial crisis as part of this current market. On the note of those large stocks that are doing rather well, they have, as shown last quarter as well, showing these charts again, but adding some additional color, the 7 largest stocks, oftentimes referred to now as the Magnificent 7, represent 29% of the S&P 500's market capitalization. That's the largest it's ever been in terms of a small number of stocks representing that much of the index. The return through the end of last year was also quite strong. A little bit cooler in this last quarter. The Magnificent 7 were up 13%, whereas all other stocks in the S&P 500 were up 6%. Up 6 is nothing to sneeze at for a quarter, but 13 is quite strong. One of the big drivers in the last number of quarters has been NVIDIA, the AI chip maker. And it's interesting to see that it took them 24 years to get it to a $1 trillion valuation, and then only the last 9 months to get to a $2 trillion valuation. They are now third in market capitalization after Microsoft and Apple. So there's a lot of excitement around the AI or artificial intelligence space. And some would say that there's been some piling on with that stock, and that some of that valuation is justified, but some of it may be demand-based beyond maybe what the intrinsic value is. Time will tell. However, at the same time, a couple of the Magnificent 7 did have weaker returns. Apple dropped 11% in the quarter, and Tesla almost a third of their market valuation cut during the last quarter due to lowering forecasts and lowering demand for electric vehicles after what may have been a relatively high peak period, and so an additional competition. So that's been a challenge. A lot of these big companies that have done so well are not immune to challenges. A lot of firms, especially those large companies, have had strong earnings, but there is some concern growing about some bubble element with some of those larger stocks. It's important to maintain diversification beyond that small number of stocks. Overall, on a similar note, valuations, with market continuing to chug along quite strongly, is now out into the upper range, outside the more normal range of valuations, and this would suggest an element of overvaluation. You can see the price earnings ratio as a measure of valuation here, where those that are based on that measure the most out of range or overvalued are in that large cap or mega cap stock category. You can see that the US stock market here relative to 25-year valuations hovering in the squarely in this upper, almost in the upper quartile there, whereas most other world markets are much more attractively priced. That can imply that there could be cooling in US stocks and some rebound in international stocks, but there's no way to know when exactly that will happen, and it rarely happens in a smooth line. Bonds overall, the yield curve shifted up, rates went up. That's relates to why prices went down for the quarter, given what was mentioned earlier about inflation and the Fed holding off on lowering rates. And to the topic of the overall growth of the economy and the question of the likelihood of recession, the key drivers for the somewhat above long-term average growth were primarily around consumer spending, especially in healthcare and federal and local spending. However, there are concerns that the consumer has extra savings left over from COVID stimulus programs has been spent down, credit cards and delinquencies are going up, and that may imply some cooling in spending. The consumer represents 70% approximately of GDP in terms of where revenues come from. And when consumers back off, that can lead to a cooling. That would be good for bringing inflation down, but it does also bring the overall economic activity down and could lead to some market cooling to some degree. That level of inflation I mentioned has come down, hovering pretty stubbornly around that 3% level. That's why the Fed has been reluctant to lower rates. Oil was a big contributor in the rise during a period and was part of the cooling, but there are other drivers that have been hovering or causing some of that impact. And the recent slight uptick from 3.2% inflation to 3.1%, sorry, 3.1 to now 3.2% inflation was a little bit of a surprise uptick, partly related to oil prices. Overall, you can see the 30-year pattern of rates coming down, then now near 0% for a long time, ratcheting up here, and then COVID happened. The government and the Fed brought rates back down to stimulate the economy. Now they're hovering at this level and expected to come down, not down back to zero. The Fed does want to bring it back down towards a level where there is room to cut should or when economic stimulus is needed in the future. Here's what the projections for rates are between the market in green and the Fed's projections in blue. Are about 3 rates cuts that the Fed is expecting to do in 2024. The market, which was previously projecting a more aggressive set of rate cuts, is now actually more conservative in their projections than the Fed. So will be interesting to see what happens in over the course of the year, and a big part of that will depend on what happens with inflation. If we look at the impact of these dynamics on the bond market, we can see ultra short bond funds, short-term or defensive bonds, and intermediate bonds over the course of period of time. 2023 was looking like it would be the second consecutive negative year for the first time in a while. But then as the expectation that rates would cool increased, bonds got a real boost in November and December, leading to quite a strong positive return for 2023. 2024 so far, however, because the expectation of lowering rates has backed off, it led to a little bit of volatility here in rates, with leaving the first quarter overall relatively flat. That's a reminder as well for those, while rates are still high, if you have cash in sweep accounts or in a savings account or in a checking account or some other vehicle that's paying near 0% interest rate at a bank, if that's not money that you need in the short term, it may make sense to use something like money markets or some other liquid short-term vehicle to get some boost of return without increasing risk. And of course, if it's materially longer, especially if it's longer than 5 years, then that might merit a more long-term type portfolio. So take a look at your short-term money or the money in cash and consider that. And as rates actually come down, money that's in money markets will continue to come down with rates, but money that's in bonds will get a boost due to the yield compression effect. So if it is longer term money, there are some medium-term benefits from holding bonds, if depending on your time horizon and your risk profile. Unemployment, as mentioned, has been hovering, picked up a little bit, but roughly hovering around that 3.5% to 4% range. Consumer confidence has picked up, which is a little surprising to us because people have been looking to the stock market maybe more than their own savings accounts. And while it's still below the long-term average, savings has cooled considerably over time, especially in the lower income levels. And credit card balances, credit card delinquencies, auto loan delinquencies are creeping up. And that is a sign of a little bit more fragility and possibly a sign that there might be less spending, which, as mentioned earlier, could cool the economy a bit, which could then bring confidence back down a bit. Overall volatility is very low recently, and oftentimes very low levels of volatility are followed by somewhat higher levels of volatility. So it's good to just be aware of that and not be surprised by that. And we have some new blog posts on the advisory group's blog regarding combination of topics from wealth management concepts for Gen X and retirement, ideas around how to lower your tax bill, long-term planning in terms of longevity and financial planning topics, how to thrive financially as an independent woman, and smart spending policy for endowments. So if any of those, take a peek at the blog, and if any of those are topics you'd like to discuss with your advisor or discuss with us, please reach out. We'd be happy to talk about them. With that, well, thank you for joining us today. It's always a pleasure to have you. We'll see if there are a few questions. And while some questions are coming in, I will just very quickly pass through the second set of slides so that you see what's there in case you'd like to circle back and ask some questions about that. A reminder of the overall process we go through with all of our different client types. Reminder of the concept of different timeframes and asset allocations that may be appropriate. Of course, that requires specific review in each case. The capital market projections we talked about last quarter by asset class. The fact that projected returns are going up for the next decade, especially in bonds, given what's happening with rates. And a number of other metrics that you might want to take a peek at if they are of interest to you. So with that, we will see if there are any questions. And I'll be looking at the questions in a moment, and thank you for being here today.